Good evening, everyone. Can I extend a very warm welcome to everyone here tonight for the discussion on the paper Investment Risk for Long-Term Investors, Risk Measurement Approaches and Considerations for Pension Funds and Insurers by the Risk Measures Working Party. I'm Richard Galbraith. I'm a member of the IFOA Council, the Risk Management Board, and I'm Chief Risk Officer in Mobius Life. So now to introduce the topic tonight. So we have the Working Party next to me. So starting with Susan Hugh at the right-hand side. Susan is a qualified actuary with over 12 years of experience. She joined Aviva in 2011 and is currently a senior risk actuary within the actuarial function team. She focuses on economic capital calibrations. Prior to that, she was consultant in Ernst & Young for 5 years, and she's got extensive experience in assumption setting and reviewing results across all reporting metrics. In recent years, she's been working in areas which focus on credit-related assumptions. Next to Susan, we've got Belinda. So Belinda is chairing this working party. So Belinda Hugh is a qualified actuary with experience in the life insurance industry. She's also an investment professional and experienced investor. She covers a number of asset classes, including equities, fixed income, and alternative investments. As an author and researcher, she's been inter alia, being a founder member of the chair of the IFOA Risk Measures Working Party since 2016. Next to Belinda, we've got Andy Jinks. Andy's one of the chief actuaries in insurance and investment teams and leads the GAD's advice on a number of investment-related issues, including the GAD asset liability modelling, in particular in relation to providing support to the Pension Protection Fund and Pensions Regulator. He's also worked on the transfer of Royal Mail's pension scheme liabilities and assets to government and subsequent sell-off of transferred assets. Further, he's also been involved in the launch of a new asset class for the sale of student loan. And also, forthcoming sports, the Lord Chancellor is part of the review of the personal injury discount rates, or as everyone will note here, the Ogden rates. Next to me, we've got John Spain. So he's spent 16 years with Duncan C. Fraser and Clay & Partners. After that, John spent 28 years at GAD. His whole career was spent in DB pensions, previously advising a range of private sector trustees and sponsors in scheme funding and M&A. At GAD, he's acted for a wide range of public sector pension clients with diverse problems. Apart from gaining his FIA in 1977, he's qualified as Fellow of the Chartered Institute of Arbiters in 1997. No longer acting for clients, he's continuing personal research focusing upon long-term budgeting. Also on the phone tonight, audio only I'm told, is Mahesh Bora. He's a member of the IFOA and he's nearing qualification as an actuary. He's also certified FRM and ACA. He's got extensive experience in the banking industry across varied areas, namely capital stress testing, asset liability management, financial planning and analysis. Currently he's working in Treasury and liquidity risk management function of the sales and trading business at Citibank. So I'm now going to hand over to Belinda. Are you kicking off tonight? Thank you.
Thank you, Richard. Good evening. Welcome to Investment Risk for Long-Term Investors. First, the necessary technical housekeeping bits. The subject matter we are dealing with is inherently subjective, and all views expressed both in the paper and this evening are those of the individual authors and presenters, and not of those of their employers or affiliated organizations. We are not giving any form of investment advice. And the last point is simply a reminder to be extremely cautious when visiting this material at a later date. So on to the agenda for this evening. After I introduce investment risk, John will then present from the topic from a DB pensions perspective, after which Susan will present from a life insurance perspective. And then, technology permitting, Mahesh from New York will be walking through his section on equity portfolio risk and return. And then Andy will be summarizing the proceedings, but before that, he will be looking at some alternative approaches to risk measurement. And following that, we will have a Q&A panel session with the chair, and you're all encouraged to contribute and participate. So the scope of our research is very simple in terms of framework. There are just two things you have to ask yourself or remember. One is, what risk are we dealing with? And the other is, from whose perspective? We're dealing with the topic of investment risk from the perspective of the investor, the primary and most important stakeholder without whom the investments would not exist. So what then is investment risk? Okay, these two charts represent cash flows available at a given future point in time. They are not present values or reserves on a balance sheet. They're just single cash flow amounts at a given point in future time. So the green shaded bars are the targeted outcome. On the charts on the left and right, the height of the green shaded bars is the same because this is one targeted outcome for one single point in time. On the chart on the left-hand side, that's the scenario where the actual result is less than the targeted outcome, so there's a shortfall, generating shortfall risk, whereas in the scenario on the right-hand side, the actual result exceeds the targeted outcome, so in this case, there isn't a shortfall, but in fact, there is a surplus. Before I hand over to John, there's just one more point I'd like to make, and that is we're dealing in the world of people, of humans, of emotions, of social transmission and institutional structure. And the next slide really speaks for itself. So I won't be saying too much, just enjoy the silent movie. Thank you.
Mr. Galbraith, ladies and gentlemen, I'm really pleased to have been part of this working party and to be here tonight to give comment on a couple of aspects which particularly interest me. While I wouldn't want to suggest that anybody breaks the law, I hope you will agree that regulations ought to be fit for purpose and they shouldn't be just following regulations blindly. One of the problems over the last 15 years is that DB pension schemes have had their funding assessments based upon essentially what is a form or an interpretation of financial economics, which basically hasn't worked. And in fact, there is no evidence anywhere that financial economics can be applied successfully for long-term entities. If anybody can find such evidence, please let us see it, but I've asked a couple of people to find it for me, and they've not been able to. This idea is not new in my mouth. Simon Kahn wrote this in a staple in actuarial paper back in 2004. I agree with him on that. It would have been great if some of the papers on applying financial economics to DB pension schemes had included some sort of back testing or future stochastic processes, but they didn't. One of the things that we're told is in DB pension space that we should be aiming at prudence. The trouble with that is that unless we know what the best estimate is, we do not know if we're being prudent or over-prudent. And I don't believe there are many, if any, such estimates of best value. IAS 19 is not a best estimate. One of the things also about financial economics is that volatility is expressed as being a risk, leading to volatility, leading to deficits. Unfortunately, the assumption is then made there will then be no volatility, everything will stay the same. Whatever was in the FT this morning about conditions last night, it will stay the same, which seems to me inherently contradictory. Now, that is actually not the major problem. The major problem is the discounting process that has been applied. Present values, V to the N, and all that sort of stuff. We claim to understand risk, but there's very little information ever provided to stakeholders in DB pension space about the risks. As far back as 1977, a New York University professor said that. As recently as 2012, together with ACCA and CISI, Long Finance produced a report on accounting on a confidence basis. Not everybody believes that's a good idea, but the idea that points in time and what you see or you think you see at points of time may not be terribly helpful is definitely still around. And one of the other things is that when we produce a number that is based upon v to the n, we don't actually say what that represents. Is it a mean, a mode? Is it a specified percentile? It's certainly not super contribution rate. You could say that the pension fund liability might be best looked at as a probability distribution. That is not my original thought at all. Tom Shucksmith said that back in 1948 on Colin Puttridge's 1948 paper. I wasn't there, but it is in the JIA literature, well worth reading. Risk quantification is very poorly captured by scalers, and we should be moving more and more, if not completely, towards stochastic approaches. Yes, all we had was capitalization. We've had it for 2,000 years. We can do better now, and we ought to. Compression over time destroys information, and that leads to fake news. For long-term projects, we should not be using discounting alone. Finally, and as our chairman is on council, perhaps I can ask him to take this back to council, could the profession please start looking more closely at what our USP is? I've wondered about this for over 30 years. I've been asking presidents for the last 10 years, not all of them, to start concentrating upon that, because it's not teaching mathematics. It's not about doing clever stuff, algebra, because anybody can do that. Anybody can play with big data. We should be contributing judgment, which is better informed than we can ever get from discounting. There is one unique future, but none of us know what that will be. So we need assumptions. But if we're going to use assumptions, let's use them intelligently. I look forward tonight to an engaged discussion. Thank you.
So I'm covering, from an insurance perspective. So I thought the first thing that I want to talk about is some of the factors that might be driving, changes in investments in real assets. There's been a shift in or change in product demand over the years. And in particular, there's been a shift away from with-profit products, where traditionally, we've had quite a lot of investments in equities and property, to unit-linked products having gained favor over time. And a lot of this is driven by the fact that consumers have started to lose confidence on with-profit products following the fall of Equitable Life and the mortgage endowment mis-selling scandals. Now, unit-linked, there's still a relatively large proportion of investments in equities and property. However, this is not really within the control of the insurer. It's all driven by consumers, what they want to invest in. So some of the things that we looked at was around Solvency II requirements, where the Solvency II formula capital charge for Type 1 equities is 39% and 49% for Type 2 equities. And you can look at that and think, oh gosh, that's a very big amount. Now within the equity shock, they do include this a symmetric adjustment of plus or minus 10%. But that's something that's only been adopted by standard formula firms so far. We're not aware of internal model firms using it. And that symmetric adjustment is calibrated based on how current index values compare versus index over the last 3 years. The other thing that, where Solvency II requirements may, may affect how insurers invest in real assets is how the solvency capital requirement is calibrated. It's based on a 1-year value at risk approach. We should really be asking, could this be putting too much emphasis on short-term volatility rather than thinking about, long-term volatility? Insurers have liabilities which are very long-term, and having a 1-year VaR framework, could this be incentivizing insurers to sell in short term when the market is very volatile, rather than holding on and withstand the long-term volatility? The other thing around the Solvency II framework is that it requires assets and liabilities to be valued on a market-consistent approach. Again, could this be leading to pro-cyclicality, where in times of falling market values, this could be getting insurers to sell higher risk assets to fund purchases of lower risk assets? And again, it's all thinking about, should they really be riding the volatility? So between 2016 and 2017, the UK Treasury Select Committee carried out an inquiry into the Solvency II Directive to understand how it impacts the insurance industry. So we've pulled some of the select feedback, which is relevant to our research on the slide. So here are some of the comments that the insurance industries have made to the UK Treasury Select Committee, where there have been some critique of the market-consistent techniques, where it's been noted that market-consistent techniques are neither stable or verifiable for the full range of assets and insurance liabilities. In particular, the requirement of a market-consistent technique is that it assumes that market-consistent hypothesis holds even at any point in time, and assuming that the prices reflect all available information to the market, and this may not necessarily hold true in crisis. Another comment has been that market-consistent approaches have discouraged investment in equities other than when policyholders bear the risk, such as on unit-linked business. Now, we could look at it, from the positive and the negative angle. So where it's positive, it could be that this discourages firms from giving over-generous guarantees. But however, this could also be viewed to be discouraging long-term investments. So for example, if you're looking for strong returns over 20 years, or real returns, then you might expect that this to be positively correlated with inflation. But over a 1-year period, you may see that it may be negatively correlated. The other thing that is worth mentioning is that there have been some comments or there's been a general theme that insurers felt that due to the stringent requirements underlying Solvency II requirements, and in particular, sort of like the matching adjustment constraints, that quite a lot of companies have to jump through hoops before they could include suitable assets within the matching adjustment portfolio. So examples of this, having to restructure floating rate notes for equity release, or decomposing property assets into income strips and residual property values. So what are the potential mitigants? Well, within the Solvency II requirements themselves, the long-term guarantee package, the allowance of a matching adjustment and volatility adjustment does help to balance things out a bit. And then, earlier we mentioned about the equity dampener, but again, the take-up tends to be standard formula firms. these measures are still viewed by the industry as overly prescriptive, and who knows, there may be an opportunity post-Brexit for a principles-based approach. There was also feedback that while matching adjustment has a generally high take-up in the UK, volatility adjustment was viewed on general that the rules were still too rigid. So what else could we do or think about, how to reduce pro-cyclical effects? I've pulled this out from a paper from Cameron Foroughi, where, he suggested 4 main things to consider. One is that do not pin all your decisions purely on one metric and think about, multiple metrics. Recognize that market consistent or market hypothesis may not necessarily hold in financial crisis. Thinking about, the regulatory system regime, which is a bit more flexible in times of crisis, and then making sure that, you shore up capital requirements during benign periods to meet losses during crisis. I'm going to hand that to Mahesh.
Good afternoon, everyone. I hope you can hear me well. So I'll be walking through over the equity portfolio risk and return section. Here we shall review equities as an asset class, specifically in the context of a long-term investor, and basically look at risks as well as returns in the context of a long-term investment. So moving on to slide 16. Here we have illustrated the S&P 500 equity returns realized over the past century. We have chosen S&P 500 as a representative of an equity investment portfolio, as it is a globally recognized benchmark of well-diversified equities. In the chart, we have illustrated the S&P 500 annual total returns for various periods of investments, ranging from around 1 year to up to 30 years. The blue dots basically indicate the annual returns we have observed over the past century. In the 1 year period, we can see the blue dots ranging from minus 50% to up to higher than 60%, which basically indicates that over the past century, annual returns for a 1 year period of investments have been negative 50% and as high as positive 60%. This indicates the short-term variability of equity returns. However, as we go along and the investment term increases, the variability of equity returns reduces significantly, which we can see from the results as the returns kind of converge to around a certain level. And this is the key for a long-term investor. Going on to slide 17. Thank you. So here we can observe the annual average S&P 500 total returns in the light blue bars and the standard deviation of the S&P 500 returns in the dark blue line. Here again, we can see that as the term of the investment increases, given our observations from the earlier slide, the volatility of returns reduces significantly as the term of investment increases. While the average returns of S&P 500 across all of these terms of investments is broadly consistent within the 10 to 11% range, 10 to 11% per annum range, indicating that even though the returns are pretty much similar, as we invest for much longer periods of time, equity tends to deliver more consistent and more consistent returns with much lesser risk. Turning on to page 18. Here we are looking at the performance of equities against possible desired investment outcomes, like meeting inflation. In the graph below, we have reviewed the average annual performance of S&P 500 compared to the US CPI. The US the outperformance of the average annual outperformance of returns of S&P 500 compared to the US CPI is represented in the light tan bars, and the dark tan line represents the number of observations during the past century when the S&P 500 underperformed the US CPI. As we can observe from this graph, there's a very high risk that equity returns underperform inflation when the term of investment is up to 5 years. However, this risk reduces significantly as the term of investment increases beyond 5 years and disappears when the term of investment is 20 years or greater. This signifies that over the past century, equity returns have always been higher than inflation when the investment term has at least been 20 years, with the average level of outperformance of around 7%. Moving on to page 19. Here we compare the equity returns against alternate long-term investments like government bonds. So similar to page 18, the average annual S&P 500 outperformance is represented in the light gray bars, and the proportion of observations in history when equities underperform the US 10-year Treasury yields is represented in the dark gray line. Again, there's a very high risk of equities underperforming the treasuries, more than 25%, when the term of investment is up to 5 years. As the term of investment increases beyond 5 years, there's a decrease in the historical proportion of underperformance. And beyond 25 years, we haven't had an instance during the past century when equity returns were lower than the 10-year US Treasury yield, with an average outperformance of around 5% per annum. This analysis basically all indicates that in terms of equity returns, the risk needs to be taken in the right context of a long-term investor, because what's risky for a long-term investor, for a short-term investor, may not necessarily indicate risk for a long-term investor. So the risk has to be evaluated in the right context. Before we move on to the next section, I would just like to add that the analysis that we have presented here basically takes into account the equity performance of the past century. While we do understand that the past behavior may not necessarily prove future performance, we believe that the conclusions are credible, since this analysis uses data for over a century, which basically means a sufficiently large number of sampling points, while it also includes periods of significant macroeconomic and geopolitical influence, right, like the 1929 Great Depression in the US and the 2 World Wars. Thank you.
Thank you, Mahesh.
Okay, so sort of summing up, I suppose the key ask of the working party is essentially how do risk measurement approaches influence the investment decisions that entities are making, and whether that's leading to sort of suboptimal decisions in terms of their asset allocation. So we've heard from John and from Susan on how these things are actually sort of playing out in the industry as we speak. My job at the end here is just sort of to try and take a step back and sort of look across entities and with people with different problems that they're facing, and to speak more generally. So I'm going to start off by going through some sort of relevant considerations that you might consider when you're sort of setting your risk measurement approach. I'll go through a few, some of which are familiar, some of which are probably less familiar, and then I'll try and summarize some of the key points that we made in the paper. A general point up to all sort of risk measurement approaches is that a lot of the sort of decisions that the entities are facing here, they're facing a vector of cash flows rather than a single point. So John said that compression suppresses information, I think, and I think that's a sort of one of the key points that applies across all the risk measures here, and we'll come on to that as a limitation. So starting with the considerations, these were the sort of the areas that we think are relevant when deciding upon your risk measurement approach. So starting with the modelling methodology, so that's in terms of the valuation method and the assumptions that you're going to use, such as the discount rate or how you're going to place a value on the liability. You need to think about what time horizon you're doing your projection over. So are you looking at your risks over a one-year measure? Are you looking at over multiple years? Or are you projecting to ultimate when all the claims have been paid or all the benefits have been paid? You need to think about your asset calibration. So are you going to mark to market in your asset calibration? And your confidence level. So Solvency II obviously refers to 1 in 200, but other areas use other confidence levels when they're looking at what level of risk. A lot of risk measurement approaches will think about applying shocks. That is the definition of risk, I suppose. But in defining those shocks, we need to think about what magnitude of shocks are we going to consider, and when are they going to play out? So are we assuming that those risks materialize immediately, and we're interested in the recovery from that, or are we interested in those risks emerging over a period? Perhaps most importantly, what are we going to measure? So are we going to measure value at risk, tail VAR, expected shortfall, and so on and so forth? And I think I'd probably say the most important thing is how are we going to communicate it? So someone has to make a decision on the back of that risk measure. So the key thing here is how we're going to communicate the risk measure that we're thinking about. A common theme across all the risk measurement approaches that we looked at and considered is that none are perfect, in particular in relation to emerging and unknown risks like climate change. It's very hard for any risk measure to capture those. So I'm going to go flick through sort of at a high level some risk measures that sort of cut across practice areas, starting with market values. So hopefully familiar, broadly defined as the price at which price to pay or be paid to take ownership of an entity's assets and liabilities, widely used in regulatory and accounting circles. You might argue that strictly this isn't a risk measurement approach, it's more of a benchmark assessment of solvency, but we thought it was worthy of inclusion of comment because it's likely to be a particular interest during periods of stress, which are when risk measures come into their own. The key advantage of market values, so they're objective, they're based on recent marginal trade. You can go to a Bloomberg terminal and look them up, and therefore it's simple. They're transparent, at least for things that are listed on a Bloomberg terminal, and they're immediate, so that they're evolving and they're updating every second. They do, of course, come with some downsides. So one might argue that they encourage an overly focus on accounting values, which you could question whether that is truly reflective of the true economic substance of an entity's obligations and liabilities. And the fact that these things do update, in seconds, might sort of provide too much of a focus on the short term, especially when for the long-term investors that we're sort of considering here, their liabilities are more likely to move at a more glacial pace. So there might be a mismatch there. They also, of course, depend on marginal trades. So the price that's paid is more reflective of that marginal trader's circumstances, which may not be representative of the universe of investors that we're interested in. And although they are available for lots of things, they're not available for a lot of other things, not least unlisted assets and many liabilities. So moving on to volatility, again, maybe not strictly a risk measure, but sometimes can be, and is often a key assumption in other risk measures. So we need to be clear about whether we're talking about observed and historical volatility or the sort of prospective volatility. Again, a lot of the time we're focusing here on prospective volatility and how that feeds in as an input to other risk measures. It also is commonly used and relatively straightforward to understand. Most of our clients or decision makers may not have actuarial qualifications, but they probably understand a standard deviation from their GCSE maths, hopefully. And the advantage for us is that there's plenty of data from which to set assumptions for it, and it also makes our life easier when we're building our models. The disadvantages of using volatility are sort of well known, not least asset returns not being normal or log normally distributed, and correlations not being constant. So in those times of stress, when you want your risk measure to sort of to hold up and give you a real and see whether you're right, the chances are that the correlations aren't constant and may cause you some issues. The other key thing that volatility's got against it is it doesn't necessarily link to the objectives of the investor or capture all the risks that they face. So it doesn't really say anything about the liquidity risks that an investor faces. So the next one that we talked about in the paper, again, may not be a risk measure, but is a way of setting a discount rate assumption in a funded pension scheme, and we think it might have relevance and read across to other measures. So this is, hopefully the animation works. So essentially what we're doing here is we're considering the return on a fund for pension scheme investor over the full term of the liabilities. And essentially what we're going to do is we're going to use that distribution of returns to help set the discount rate, which is an important part of the valuation basis. So let's say that the return has an expected return of 3%. I've said over inflation there, but it could be over gilts. It doesn't really matter. We're just trying to illustrate the point here. The key thing is so how this is often, how I've seen this used is the level of risk. Often one of the key considerations in setting the discount rate will be the strength of the sponsor. So a sponsor with a strong covenant, you might set the discount rate quite close to that expected return. So you'll set it with 2.25%, and in that case you're 60% certain that you'll beat 2.25%. Whereas for a weaker sponsor, you might want to be a little bit more prudent in your valuation approach and have more confidence that you're going to beat that. So you might set the discount rate at 1.5%. So the advantage of this approach is that you're being more explicit on the level of prudence that you're setting, and you're articulating the level of investment risk that you are taking. Now, what the paper discusses is briefly is whether to flip that and to almost ask whether that could be flipped, and you ask the question: what level of return would be needed to meet a certain probability of meeting a given set of liabilities, and how that might compare to a cost of capital approach. The final risk measure that I'm going to talk about is probability of success and failure. So the paper refers to a case study on this of how the PPF use this, and this is where that chart is nicked from. So essentially here, the institution starts by defining what success looks like, means to them, and what failure means to them, and being clear on when that assessment needs to take place. So when the PPF do their assessment, I'm not sure whether this is working, they measure success or failure at the end of this chart at 2030. And essentially they've got a stochastic model that simulates the position of the entity, and scenarios above this red line would count as success, and scenarios below this would count as failure. Now, the advantage that this approach has over sort of other risk measures is that it is linked to the business objectives, and it's also in particular in respect to the time horizon. So the investment period that you are making that risk assessment over is fully reflective of the period of investment. There are drawbacks, not least building these sort of models is a significant undertaking, and you still can't get away from the fact that they rely on several key assumptions. So in here, the economic scenarios that are being used and behavioural ones that may be outside of your control, but it does give you value. The other key challenge with this is, especially when you're doing multi-year modelling, is allowing for management actions. So you're defining success and failure in 15, 20 years' time, the chance and trying to use, demonstrate those results to the board to allow them to make a decision. But the chances are that they won't be here in 15 or 20 years' time, or their successors might not make the same decisions that we assume that they're going to make. So it does sort of amplify the sort of, but that conversation can be helpful to sort of actually discuss and get agreement on that. The other potential risk is that it sort of leads to over-reliance on the modelling and provides false comfort. So that's a very quick flick through some of the risk measures that are considered in the paper. There are some others in there. What were the key themes that we sort of found when we were doing all that? The first one is that these things matter. So both business management decisions and the risk measurement approaches that are mandated by regulators do have an impact on the way that entities are making investments, and that the optics here can make an impact. So people are either required to comply and report in a certain way, or they have a desire to comply and report in a certain way, and that does drive decisions. The second thing is that the key risk to these entities does not depend on what they are investing in, or the investment, the risks that are associated with the investments that they're investing in, but on their objectives and on their ability to meet their liabilities. So essentially what we're saying is the fundamental economics of them needing to meet their liabilities doesn't get the same level of attention as regulatory risk measures, or indeed some of the behavioural biases that can come into investment decisions. The third one is the way that investment risk is framed often sort of puts a focus on the short term. So rarely do we say the risk of poor returns from low risk investments. We tend to more focus on the risk of higher risk investments. And the key point that we're trying to make there is, as I said earlier, that the market risk of investing in equities doesn't equal the investment risk that a long-term investor is making. And the liquidity risk isn't the same as being able to sell their investments quickly. It's about them being able to make sure that they can meet the cash flows that they've got to meet. Fourth, risk avoidance itself is risky. So this is emphasising that there are two sides of a distribution. So a lot of focus is on the left-hand tail, but quite often there's not as much focus on are we giving up the right-hand side of the distribution. Fifth, one size doesn't fit all. So as Susan said, the Faraghi paper did say that reinforces the point that there's not just one magic number here that we should all be focusing on. And finally, a shifting landscape. So what we mean by that is things change, and it's important for us all to make sure that we keep on reflecting and asking ourselves, are the risk measurement approaches that we're using fit for the purpose of which they're being used and for making those investment decisions? Thank you.
Thank you, Andy. Cheers. Okay, so the discussion is now open to the floor. Thank you for such a really great presentation and summary of the paper. I'm looking forward to a really interesting discussion. I encourage anybody to raise questions and comments, ideas that they may have. Can I invite anyone who thinks that they might wish to contribute what you actually want to discuss, if your intention. And a reminder that this meeting is being recorded for publication in the British Actuarial Journal, so please clearly state your name before making your contribution. And we've got some IFOA staff wandering about, and they will bring you a microphone, so please wait until you get the microphone. So, who would like to kick off a question? I'm looking around the audience at a few friendly faces. We've got someone in the front row here. You're very welcome, Andrea. Well, there's a microphone coming to you, so okay. Yeah. Well.
That was neat gin. Hello, I'm Andrew Slater. Just got they're not questions, they're some comments and observations to make. First, I have two, but first just want to say I welcome this paper. I think it's long overdue to have a paper that reminds us that we are talking about a social science and not physics. I have sat through too many papers in this hall trying to present financial economics as a branch of physics, which it's just not. And those who have been unfortunate enough to listen to me in this hall over the years, and there have been many years, will know I'm not a fan of financial economics, and I've cautioned that its naive application is dangerous, and I think we have seen some of those dangers highlighted by our speakers. My first comment is focusing more on the investment side, where one of the key measures or key characteristics we care about is around the equity versus inflation. I was taught when I started my actuarial training that equity investment is a good match for inflation in the long term. I come from a pensions background more than an insurance background. Then we had financial economics overturning this almost overnight with its, I'll say, dogma of the only investment is fixed income and discount rates are risk-free, whatever that is. I would say both approaches are right and both approaches are wrong. And the reason I say that is that there is a term structure to the correlation between inflation and equity returns. At very short durations, the correlation is zero, it may actually be negative. But as the term increases, maybe up to 20 years plus, that correlation does increase to around 0.4, 0.5. And this is something we observe in the UK, the US, many other markets. It's not unique to the UK. It seems to be a permanent feature of the markets. Therefore, both are right, depending which ends of that term structure you're looking at, and both are wrong because neither is looking at the full picture. Neither approach takes into consideration the purpose or time horizons and many of the other features that the speakers were talking about. My second observation is if we are talking about short-term versus long-term, we do need to ask ourselves, how long is the long term? A few years ago, I heard Professor Elroy Dimson from London Business School, who has the definitive database of long-term returns from an increasing number of countries, give his answer to that question of how long is long-term. And he had used his database to analyze country by country what period of investment do you need to have a high degree of confidence. I forget exactly whether it was 95 or 99% confidence that equity will outperform inflation. And the answer is, depends on country, at the shortest was the US at 17 years, and the longest was Italy at 77 years. Therefore, the long term can be quite long, but the long term is different from the short term, and for those reasons, I'm very grateful for this paper and look forward to the rest of the conversation. Thank you.
Thank you, Andrew. Do you have any comments just before we kick off? Any thoughts on Andrew's statement?
One thing I'd probably just say is that when we were writing the paper, we did have a brief discussion on what do we mean by long-term And I agree with Andrew that it's not really easy to define. I think we probably found it easier to define the long term by what it's not than what it is. So I think it was easier for us to say these investors are probably short term and out of scope than it was for us to say these are long term investors and therefore in scope. And so that's why we were intentionally quite vague on that.
Thank you. So a question here first, and then I'll go to you in a second. You can come up here if you'd like, or there's a microphone going around.
That's okay. I think I'd rather do it so. Thank you.
No, that's fine.
So thank you for the paper. I'm reminded of the words of a very wise colleague of mine many years ago who reminded me that risk is an ex-ante concept that has an ex-post friend called pain. So whenever we look at risk, we are often using past data, whereas clearly risk is totally a forward issue. I'm probably a greater fan of market values than most of the people in this room, possibly the panel, although clearly they have deficiencies. And I wonder if the working party has spent time looking at All Swans Are Black in the Dark, which tells us quite a lot about how risk is priced by markets or not priced beyond about 3 to 5 years. So the foundation of market values, and picking up one of the points from, was it the Ferrugi slide, it's not just in crises that things may be different, it's also on a sort of regular basis. If you want an example of a risk metric, slightly esoterically, I offer you the risk of the inevitable policy response of regulators and policymakers to the Paris Agreement. We're probably familiar with the Paris Agreement, the ratchet effect, and the fact that the countries have to report on their sort of climate change policy. So I suggest one risk is that there'll be a severe policy response in the coming years. There are people beginning to quantify that, so it's actually a quantifiable risk. Putting a probability on that, which will lead to regulation, to possibly the pricing of carbon. So lots of good sort of rich forward risks. When people speak about investors, and I think not often having been an advisor as an actuary in this sense, we ought to think about the time horizon of our principals. So our principals will be trustees, there will be insurance companies. In my world, we talk about asset owners and investment managers. Investment managers basically do what their asset owner clients want. So I think the time horizon of the asset owner, which may be long term, and we encourage the long term, but actually their position may be shortened. There may be a move suddenly to buyout. There may be evolving policy and regulatory changes. So although we love the long term, we need to be aware that all of a sudden we may need to walk across the road to an insurance company, and it actually is the market values that count. And for the record, anybody who doesn't value liabilities at other than bond rates, I believe is misguided. I'll buy that bit of financial economics. Clearly, if you put it together with the liabilities and the assets, there's a question about monitoring an entity. So the other comment just to think about is beta in financial economics is not a given. If I'm an asset owner, I can begin to choose my own beta. We tend to think of beta as a sort of simple specification of the market. But as a trustee, I can decide to avoid carbon risk if I believe it is mispriced, which I happen to do. So I can begin to choose my own beta. So I think the financial economics that we've grown up with, we can begin to evolve that in useful ways to think about, I will choose a beta which reflects my capital market risk desires, which are not totally framed by financial economics, but by the real world risks that I face. I'll stop there, thank you.
Thank you. Can I check what your name was?
Sorry, Mike Clark.
Mike Clark, thank you. Do you have any comments from the panel?
Just one comment on that. We did talk about whether or not the sponsor did have a long-term horizon, without which the trustees of a DB pension scheme couldn't have one. That ought to be part of the Statement of Investment Principles, Statement of Funding Principles. But whether or not that is actually taken into account in either of those documents is unclear to me, but certainly it's important. Without a decent long-term horizon, you just can't talk about this stuff. You've got to go for other solutions. We agree with that.
I think the other point I'd make is we also discussed in the paper briefly the role that having delegated authority has on some of this, and the fact that if trustees are making decisions on behalf of members and so the decision is delegated, that can also create sort of certain incentives to behave in certain ways, and we discussed that briefly as well.
Okay. Thank you. I think we had another comment down here at the front. Are you? And then we'll go to the back just after this. Thank you. There's a microphone coming first. Thank you.
My name is David Simmons. I've 3 comments. I'll try and be brief. One is really less aimed at the authors, for which thank you for a good paper, but more aimed at any council member sitting here. And on slide 21, I think it was near the beginning of Andrew's section, I couldn't help noticing that in things being considered, communication was at the bottom of the list. And if the profession is serious about prioritising communication, maybe we haven't got to where we want to be. And I think if you think about communication first, maybe other things fall into place. My main point is that a distinction perhaps between what we invest in and discount rates. So I very much agree with the paper's view that what we decide to invest in depends on what our objectives are. But I don't want us as a profession to be using this to try and manufacture lower discount rates when we use them. I think there can be a distinction, and I think sometimes our profession, with the benefit of hindsight, has not been as good as it could be when deciding what discount rates are. If I have an obligation to one of you of X in, say, 10 years' time, if I'm going to hold a provision that is less than X, I want to be very confident that the provision I hold will grow to X over that 10 years. So when we refer to various areas, I think we always want to be prudent, but want to be very confident that our discount rates are going to work. And thirdly, we talk a lot about short-term, long-term, and I'm not sure if that is the terminology we want, because as someone said, they mean different things to different people. The long term is always made up of many, many spans of short term, and I think what we want to focus on is the time horizon at which we are paying out the obligations that we are looking at. Thank you.
Thank you, David. I think there's at least 2 members of the council here tonight that I can see, and I can say that we definitely do have that conversation, and I will push it again tomorrow night at professionalism session I'm holding here. Do we have any sort of comments back to David?
I'll say sorry for putting it at the bottom of the slides, and not at the top. I think the point on discount rates, I think, is a valid one. We grappled with discount rates for quite a while, trying to work out how to segment it into the paper. I think the point that we were trying to make is, or what we were trying to comment on was maybe not changing. So you talk about needing X to provision for something in 10 years' time. I think the thing that what we were trying to address is what's the risk associated, even if you've provisioned X. And how that changes if as X changes, I think was what our focus was on. And your point on making sure that it links to the obligations, that chimes with exactly what we want to say, I think.
John.
Just on short-term, long-term distinction, I think one of the things I'd draw attention to is the idea of path dependence, which very roughly suggests that where things are depends upon where you've come from. And logically, that means they will also depend upon where you're going. For short periods, you're going to have less opportunity for good things or bad things to happen. So long-term, short-term is a valid distinction. And in fact, I think the actuaries are really the only profession who have ever systematically tried to consider the financial position of long-term entities. No one else does that. That must be part of a USP, except it wouldn't help with general insurance concerns.
Thank you. I think we had a question in the far right corner, or far left, depending your perspective.
And again, I'd like to welcome the paper, both for sort of opening up this debate and re-examining it. I'm probably consistent with earlier speakers. I'm probably in a camp of it's neither one nor the other of these approaches, but both to consider the broader approach to risk and financial economics is the way to sort of look forward. I did particularly like the comments on sort of the risks around DCS, and I think actually the use there is part of what builds into the market failure of pricing some long-term risk with that focus on central medium returns rather than the variability. However, I'd like to raise 2 points and ask the panel. First of all, it's really echoing again earlier comments in regards to the countries. I would very much push back against the assertion that the US is a representative market in this sense. Again, looking at the sort of Dimson Marsh work, the period of negative real returns in the USA is 16 years. But if you were to take France, Germany, and Japan, you come up with 54 years, 55 years, and 51 years, at least in the 2018 book. So I think that gives a very different perspective. But I think the challenge, and again, if we think about the risks of modelling failure that happened around subprime, where many of the models failed to recognise that negative returns was possible in real estate across the whole of the US, is how do we think about those negative risks, particularly where we get to a point in a timeline when we haven't seen the historical observance. So how do we take the charts that you showed on the S&P and actually really think about the risks of being negative returns over negative real returns in 20, 25 and 30 years if they haven't happened in practice, because I would assert that risk is not zero. So that's one question, panel, sort of both broadening to different countries, and then how do you go on to think about the possibility of negative returns rather than guaranteed positive real returns if you wait long enough. And the other is around, again, picking up an earlier point around the ESG risks. And if climate and if we look at those future paths are going to be different, what about comments on the approach that you're thinking here and taking a long-term risk, long-term horizon in regards to market prices and risks, where current market prices are quite unlikely to be correct. And actually you have a high degree of uncertainty about the outcome, particularly on carbon-dependent companies and businesses. Thank you.
Thank you. I will put this out to our panel. I couldn't catch you. We're vigorously scribbling on the other side.
I think it is just our comment on there are many emerging risks which we cannot cater for fully. It's in one of the paragraphs in the paper, but which we didn't deal with in our slides.
So on the point about analysing whether the US is representative, John did look at that, I think, for UK equities as well, and I can't quite recall what the results were, but I think they were broadly similar. But I take your point that it does depend on the market that you're thinking about. I think your last point was on the ESG risk, and that often these are calibrated to the market, and what's the risk that these are, the chances are the market's got it wrong, and I think that's right. And I suppose it's not only is a variety of risk measures important, but also a variety of assumptions that go into those risk measures are important. And we do talk about in the paper about sort of point-in-time calibrations versus through-the-cycle calibrations. And there is a question about whether there is enough, whether people who use the ESGs are putting too much to a calibration to a particular date, or whether there is value to be had in looking at sort of longer-term calibrations for ESGs. But obviously, that's open to debate.
Just to pick up the use of the S&P indices, Mahesh kindly did all of those sums on the charts and we used them, but we did also look to see if the UK numbers were broadly consistent, and they were. Just looking at the 15-year stage, and I've got to look at this because I don't remember the numbers, and UK equity risk premium over 15 years, we're talking about two different things. We're talking about equities on the one hand and either over 15-year gilts in the UK or 10-year treasuries, which is pretty well all there is in the US. But the numbers were 7% in the UK, and I've written down the wrong number for the US, but I think it was about 7.2 on the chart. And for negative equity risk premium over 15 years, the UK had 3.6 and the US had 5.1. So they're the same sort of order, and we will update those numbers in our written response later on. Secondly, the issue of model risk, that is always a problem. All models are suspect, but some are better than others. Sometimes you're going to have to use more than one model to see if you get a similar sort of result. And in terms of looking at the fan of outcomes, yes, that can be a bit difficult to explain to some stakeholders. How do I know where I am? And the answer is, we don't know where you're going to be, but the question is, where do you want to be? How confident do you want to be that you're going to be 80%, 90% funded? Because if you do want to be there, that's going to imply a different investment strategy or a different funding in terms of how much you put in strategy, and at least they get a better answer than put in 33% and we look at it in 3 years' time. Because 33% is just one number, it hides everything else. It cannot possibly be a good number to communicate. So I agree with David Simmons, in fact, the communication of this stuff is all important. And actuaries are not generally regarded as good at this stuff, are they?
Thank you. Do you have any other questions out there? Come on, Con. Mike.
I hope I heard Belinda's comment appropriately, otherwise this will be a foolish remark. But if I heard you say emerging risks we cannot cater for, I'd like to set up the debate and suggest that every risk is emerging. If the risk is data, it's past and it's event. So just in terms of the way we think about the issue, I suggest all risks are emerging and we should be focused on the best way of helping our principals manage those risks. So a slightly pedantic point, but I think how we think about the problem is quite important. And if I misheard you, I apologise.
Well, there are many uncertainties. So, it depends on your perspective. We said there are multiple perspectives of risk, and for all the people who have commented this evening, they're adding, nuances and extensions to what we have, which, does enrich the discussion. During our research, we found a problem we constantly faced was scope creep. There was so much further detail that we could go into, and we could go in greater depth, but then, the paper would just extend to hundreds of pages. So there are things in the paper which don't come across fully, just because in order to extend them properly, it would require a separate paper all of its own. So thanks very much.
Thank you. I've got a question here in the middle, and then I'll come to Colin after that.
Hi, my name is Peter Needleman. Just a few comments. Firstly, to thank the authors for a very helpful and timely paper. I think it's very easy for perhaps some of the younger members of the profession to be wholly immersed in the sort of market consistent techniques and perhaps forget there was a time 20 years ago or more when there were many other techniques used to value liabilities or to make projections, and stochastic projections were generally of a real world nature. And what I wanted to do is just make a few comments from the perspective of an insurance company. I'm actually the with-profit actuary of an insurance company selling quite large volumes of with-profits business, and in the fortunate position where the Solvency II, solvency constraints are not, at least at the current time, a significant constraint. So in particular, recently, we spent a lot of time thinking about investment risk from the policyholder perspective. Interestingly, we still use volatility and one-year volatility as a measure of that risk, and for all the reasons that are up there. But increasingly, we're looking to think about risk from the policyholder's perspective in different ways, and that in particular means looking at their average time horizon, trying to take account of the benefits of smoothing, which further reduce the risk over the long term, and other factors that would be relevant. And perhaps one of the most significant there is diversification, because that is something which has been communicated to policyholders. So there are a number of factors there, but particularly I think this concept of getting the timescales right is really important. And for life products, that can be anything from 10 to 15 years, perhaps longer for some. But most of the contracts do have early, you can take early surrender values, so we can't ignore the short term completely and the volatility in the short term. The other major area I just wanted briefly to comment on is the use of market consistent or other techniques to value guarantees. And whilst the market consistent approaches are just accepted practice now for valuing guarantees, and they work quite well for sort of fairly basic guarantees, but nevertheless life contracts do have some long-term embedded options and other risks which are path dependent, and in fact market consistent techniques just don't work or don't work easily. And in fact in a recent pricing exercise we found it very difficult to apply those techniques and ended up using real world projections with risk premium in, but adding an allowance for a risk margin in exactly the way the paper indicates, with taking the 65th or 70th percentile. So I think where we end up is a situation where there's a sort of horses for courses. Yes, market consistent approaches are absolutely right in many circumstances, but there are plenty of situations where they're just not right at all. And I think the paper is a good reminder of that. So thank you very much.
Thank you. Any comments?
Thank you. I guess it's quite interesting to hear your comments. I think one of the things that we did as part of the research party was, we had a look back at literary reviews, and it was helpful to be reminded that not that long ago, everything was, immunization concept was in the minds of all actuaries. You wouldn't think about anything else before you went on to market consistent techniques. I think your comment about, thinking about the short term and the long term, and, how that interacts with market consistent techniques, because I think one of the big drivers in UK insurance industry anyway, the emergence of market consistent techniques, is because of undervaluing guarantees in with-profit funds and, the rise of peak 1, peak 2 reporting. And, Solvency II is kind of trying to address it in one sense, having market consistent techniques. I'm not saying that market consistent techniques is wholly bad, but I think it does help to think about, should we be thinking about trying to model things on a longer term basis? But more, but that would probably require more complex models where you would want to model the interaction between making sure that you have sufficient returns over that period, but as well as modeling the dynamic relationship between poor investment returns and high surrender rates, for example. It's then calibrating that, which is really tough. I'm not saying, but that shouldn't be a reason for us not to investigate, I think, but rather, and not just loyally thinking about, the 1 year VAR approach. The market consistent approach, in my view, is a bit of a shortcut because you're not then modeling all of the risk, and you're saying that, okay, if I've been able to model all the risks properly, then I will not take credit for that, the return on that. But it might be that if we do model it over a long term, we might find that actually the risk reward balance will be different. I guess my only last point about your market consistent techniques is that where you've had to use real world. One other thing which that's recent development in the industry is that for equity release assets, where quite a lot of insurers have typically valued them using real world projections, it's been asked to go down the route of valuing them on a risk neutral basis, using a deferment rate. Now, that's obviously a subject of another working party, but it does kind of make you think, what is a market consistent price for property, really? So, and it makes you think, can we actually get market consistent prices for all the types of options that we're trying to model?
Thank you, Susan. Con, you still have a question, just at the front here again.
Thank you for the paper. Sorry, I'm Con Keating, I'm a guest. I have already, as you know, submitted a written comment on this paper. There are a couple of points that I want to make and then a question to ask. The first is, some of the econometrics in this paper is deeply troubling. The conclusions you draw from overlapping periods. You actually have 3 independent 30-year observations, not 100 30-year. That carries significant consequences for the findings that you have. The second thing is, and this is a problem I've seen a great deal with actuarial models for pension funds in particular. You showed the PPF 2030 model. The PPF 2030 model is fine in as much as it tells you about what you might expect to see in 2030. Do not make the mistake that seems to be widely made of assuming that that tells you about the path by which you get there. To establish that path, you would need to have the assumptions and conditions for 1 year, 2 years, 3 years, all the way through to the end. That's the only way you'll get that accurate. So to the question. The question is really very simple. We know that risk means that more things may happen than will. So shouldn't we, if we're talking about risk management, be focusing on the likelihood of particular events occurring, and shouldn't we also be examining and perhaps prioritizing things by the possible consequence of those specific events?
Thank you, Con.
To pick up the last thing, we should pick up on the probability or probabilities of more things happening that may happen as definition of risk. Yeah, it would be a great idea to do that, but when you're talking about things which are almost unknown, it's a bit hard to decide, well, it's going to be 70% that Red Rum will win the Grand National again. I'll put the answer at 0 probably, but if you give me 70%, I'll take it. But you have got a problem, and yeah, you've set out a problem which cannot be answered. And if people want to put, no, you cannot put a probability on future events which are unknown, for which you've got no prior. No, all future events will include some which you can guess at and others at which you cannot guess. So yeah, it'd be nice to be able to do that, Con, but I don't think we can.
Can we have the microphone down for Mike again?
I think Connor's made a very good point. Let me see if I can frame it into a question for each member of the panel and possibly the chairman. I'm the trustee of a 20 billion pension scheme. I am concerned about climate risk because my plan sponsor happens to be a fossil fuel major. I think their covenant is weaker than most people think. I've just appointed you as my advisor to the trustees, not to do any particular work as yet, but to help me to direct my CEO as how they, to whom the scheme actuary reports, should direct the scheme actuary to do his work, given my belief, and I think to Con's point, this is an uncertainty, but we're in the measure, we're in the sort of risk measurement game. So how might you begin to start your conversation with me when I've just appointed you to advise me around what I believe is a riskier covenant than everybody else seems to think?
Thank you.
What I'm hearing is like a distinction between risk and uncertainty, and in a way it reminds me of the kind of quantifiable unknowns and the unquantifiable unknowns. I don't know what other people think of that.
Yeah, but I think, so going back to the sort of probability of success and failure type approaches, I don't think there's anything that prevents using that sort of framework in practice. It's just that the distribution would probably be a bit more bimodal of depending on the covenant risk. If the sponsor falls over, then the chances are you'll fail, and if it's fine, then it'd be a bit more successful. So, but maybe that's then achieving its purpose of demonstrating that risk in a way that it's not demonstrated at the minute. But yeah, I think you're right. We're talking about known unknowns, and whatever else. John.
I was intrigued by the suggestion that the scheme actuary could be instructed to do something, and I think that perhaps is part of the USP problem. Exactly what is it that the scheme actuary or any other actuary contributes as being a professional to the wider public? If they're just taking instructions to do very complicated algebraic calculations, which almost anybody else could do if they were just given the formula, they could write the computer program and it would be dead simple, that doesn't say a lot. The scheme actuary, in pension DB terms, is supposed to say to the trustees and have it agreed with the sponsor that this is where I think you might want to be. Now you, as trustees, have to define the parameters that you want me to use, and I suppose that is a sort of instruction, but that all the more reinforces my point that really all we are glorified clerks. And in fact, if you go back 2,000 years, the word actuary, or actuarius, actually meant clerk. 2,000 years and we're back to where we were. Fantastic.
That's a fair point, John. What I was trying to do was to differentiate between the arithmetical stuff and you who I've just appointed and your judgment as to help me to think through this risk/uncertainty which I have decided I have a view on, and how that would work through my governance structure, through my CEO, to the person you described as a glorified clerk. So I'm looking for your judgment on my assessment as a trustee of a pension scheme, and I guess it could be an asset owner in an insurance company with a fairly weak regulatory constraint. So I'm really sort of testing the thought as to how we begin to think about evaluation and assessment of these risks, which are all in the future, really sort of building on Con's point.
I think it's that V word, the valuation, which is the real problem, because putting everything back to scalers just doesn't help. But in terms of trying to have a responsible, informed conversation between the trustees and the sponsor and the actuary, you can talk about particular risks. Well, you have to start with the sponsor's game plan. And you have to look at the covenant. How long is this sponsor going to be around? How long do you really have to consider? So maybe it's 15, 20 years, so you can talk about long term. If you take the carbon stuff as an example, one way of approaching that would be, we're not going to have any oil companies, and we're going to limit our exposure to the finance behind the oil companies. That is going to limit your equity options in the UK market quite a lot. So another thing you could do is say, okay, we will invest in Shell, BP, things like that, if we think they're good. I couldn't possibly comment on that. But when we start looking at the returns, we're going to build in variance that we are going to lose 20% of the value of the returns on that particular part of the market. And that might change your mind as trustees, corporate trustee, as to whether or not you actually want to do that. And the sponsor might have a particular view on that as well, because that will imply higher funding requirement from the sponsor. And the shareholders might not like that if there are shareholders. So you've got a balancing item, and it's always going to be a balancing position. And there will be no right answer, which is one of the reasons why you have to keep on looking at it every so often. It doesn't go off the agenda. It stays on the agenda every meeting. Are we still feeling okay? But that doesn't mean doing a fresh valuation every Tuesday afternoon, because there is a system which can do that. But it's a question of balancing what you're building in. I was thinking of the known unknowns, in that we know there are these things which can go right or wrong, but we don't know by how much. Andy has helpfully mentioned the unknown unknowns. And your guess is as good as anybody else's. And so, frankly, is any non-actuaries.
Okay, thank you, John. I think that was really good. Do we have any final comments for the panel before we wind up? So, okay, I think it remains for me to express my own thanks, and I'm sure thanks to all of us, the authors, the opener, the closer, and those who participated in the evening's discussions. We were getting into a very lively debate. I've got a feeling that could have started going on to a very interesting place. We talked about communication and framing. Andrew referred to this as social science and not physics. We need to think very carefully about the time horizon, asset owners. All risks are emerging. Thank you, Mike. Solvency II constraints and the unknowns, quantifiable knowns and unknowns. I think we could sort of talk all night about that. But it would also be very helpful for those preparing the transcript of the discussion if you could hand any prepared notes that you might have taken. So I've definitely seen a few notes out there tonight, and hand them to the professions executive at the back of the hall as you leave the meeting. But thank you again. Very interesting discussion, very good paper. Thanks.